with our business partner, TA Investment Management Berhad and Janus Henderson, to share and find out what is global technology still relevant in today's environment. So the last couple of months, we have seen extreme market volatility, disrupted supply chains, gas shortages, which in turns have led to many central banks taking more aggressive actions than most anticipated. In 2022, looks to be another year of unknowns, given current monetary policy consideration and record level of inflations following the Russia-Ukraine crisis and China COVID zero tolerance policy. So hence, so far, the market have been challenging in 2022. So if we quickly pull out the data from Bloomberg for the first half of 2022, you'll be realized most of the equities and bond markets performance are underperformed, especially the tech-heavy index like Nasdaq. So on year-to-date basis, as of 24th of June, it dropped 26%, which is one of the worst point in this year. Then we follow by the global equity index, which is the MSCI ACWI index, which is what we normally call MSCI All Country World Index. It also fall 21%. Also, I think investors are quite concerned that recession may be coming, as we see the yield curve inverted with the short-term yield is basically invert over the long-term yield. So as an investor, what investors should we what investment should we really exposing ourselves into this in this tech era? Plus, we are living in this recession cycle. We'll invest into technology companies able to stay through this recessions period. Is this a corrections that we were hoping that happen as an opportunity, or will this spark of further concerns for tech investors? So hence today, we are glad to have Kenneth together with us from Janus Henderson Investors Singapore to find out more from him. So Kenneth, just a little bit background on Kenneth. Kenneth is the chartered holder for both Chartered Financial Analyst, CFA, and CMT, Chartered Market Technicians. So prior to this, he spent 8 years in private banking, and in his most recent role, he was an investment counselor in Credit Suisse, where he provide investment advice and solutions to ultra high net worth clients. So before that, Kenneth also spent 2 years in Goldman Sachs and 2 years in BNP Paribas. So towards the end of these sessions, we will be also having some Q&A time. So do feel free to post any questions if you would like to ask regarding this topic. So with this, I would like to welcome Kenneth and hand over the session to you. So are you ready, Kenneth?
Yes, I am, Danny. Thank you.
Right.
Let me just go ahead from here then. So Danny, thank you very much for the super kind introduction. And thank you to everyone for having me over here, especially to Affin Bank and TA. I'm very excited to be here today to speak to you about this topic, which is global technology still relevant in today's environment? We certainly at Janus Henderson think so. This is a very hot topic that's been coming up in a lot of our client conversations, both with high net worth individuals as well as with the institutional clients. And there are many reasons to be bullish on technology. And so for me, the objective of this session is to share with you all these reasons. And if we move on to the next slide. So as you can see that I split this agenda for today into 3 main sections. The first of which is to talk about a market recap. I want to share with you what Danny has also done. What have we been seeing so far? What have we been observing? There's a sell-off in Nasdaq, but do we really know what's going on? Because a lot of the big cap names such as Apple, Microsoft, Google, they're actually down quite a bit, not too much. But most of the sell-off is happening in unprofitable parts of the market. And then after that, I'll move on to the second part of this session, which is to share with you all the reasons why you should be invested in technology. So a lot of long-term reasons to invest in technology, but also the short-term ones. And then last but not least, at Janus Henderson, we've been investing in technology for over 24 years. So we've seen a lot of good companies, but also a lot of bad companies. And we want to share with you the attributes to look out for when you invest in a company and what kind of companies you should actually be avoiding as well. And so if you could move on to the next slide. Thank you. So I just want to start off with a market recap. We have, this year in 2022 has been a super tough year for tech investors. Um, we have had very high inflation globally. So in the US, just last month, we reported 9.1% CPI year on year. And then just last night, they reported 8.5% CPI year on year. So what this figure really means is that how much prices have been going up. And to put it into historical context, this is the highest CPI we have seen in the last 40 years. And not just that, this is happening globally. So even in Europe, we're looking at above 9% inflation on average in the Eurozone. And in some countries, such as Estonia, we're seeing more than 20% inflation. So as all these prices are raging and surging, what's happening is that central bankers around the world are coordinating their efforts to rein in this liquidity. The easy money that we have seen the last 2 years is being drained away. And at the same time, interest rates are increasing. So what this has really happened is that the tech index, the NASDAQ tech index, which is one of the most looked at tech index worldwide, has actually fallen from peak to trough by almost 32% at its lowest point back in late May, early June. It's obviously recouped a bit of it since then, but then it's still down quite a lot. It's really one of the worst bear markets we've seen in the last 50 years of the NASDAQ being born, like what Danny was saying. But the important point to take note of this is that a lot of the very good quality tech companies such as Apple, Microsoft, Google, these companies are only down 10 to 20% from their highs. So most of this sell-off is actually happening in a certain part of the market. This is the more bubbly part of the market, whereby tech valuations have gone a little out of whack over the last 2 years. And so these are typically the unprofitable, overvalued companies. And if we move on to the next slide, you can see over here that the surge in unprofitable companies has been quite unprecedented back in 2021. So the chart on the left-hand side, back in 2021, at one point, we had almost 40% of the tech, 40% of tech companies being unprofitable. Obviously, this has calmed down a lot. It's only 30% right now, but then it is still pretty high. The last time we saw this, we have to go back to 20 years ago during the dot-com bubble. So for us, we really felt that this drawdown that we saw in the NASDAQ index was really no surprise, because this is something we've been trying to warn investors for the last 2 years, that valuations have gone a bit too much, too extreme, and we didn't really like that. So we, as a company, we really avoided all these unprofitable companies, and we attribute this problem of a surge in unprofitable companies to what we call the Robin Hood effect. The last 2 years, we had a COVID lockdown, and at the same time, we had very easy monetary policy, almost zero interest rates. And then governments around the world were also handing out stimulus checks for free. And so very high fiscal policy as well. And this obviously led to a lot of retail investors being locked down. They stayed at home. They started to gamble on the stock market. They were chasing after the next meme stock, the most overhyped stock, the most talked about stock, rather than actually caring about the fundamentals of these companies. And as we emerge from that world today, we really think that the last 2 years was an anomaly, and it's really not going to happen again. So we really encourage investors to actually stay away from these unprofitable companies that are overvalued with no clear path to profitability. And just in case you're thinking of investing into them after this major sell-off, what I'd like to share with you is in the next slide, that you can see over here that this chart shows what this chart really shows is the top 20% most expensive companies in terms of PE divided by the cheapest 20% companies in terms of PE. And you can see that the most expensive part of the market is actually 7.3 times more expensive than the cheapest part of the market. And at 7.3 times, this is a historically high figure. We've never seen such high figures before, ever since we started tracking this over the last 40 years. So what this means is that even though, we are seeing names like Shopify, Peloton, they're coming down by 70 to 80%, we really do not encourage people to go into it yet, because I think there's still some room to fall. At a certain price, these companies will become attractive, but I think we are still a long way away from it. And if you move on to the next slide. Thank you. So, over here, I the last few slides I mentioned a lot of things about how we should not invest into certain part of technologies, but I want to share with you that the tech sector is something that investors should definitely gain exposure into. It still offers a lot of very attractive opportunities for investors who know how to selectively choose the right stocks. And so over the next part of this presentation, I want to share with you all the bullish reasons why we at Janus Henderson really like the tech sector still. So for me, this first one is quite an important one. We think that number one reason to invest in technology is because there's going to be an acceleration in technology adoption. We think that this is an irreversible trend worldwide. You know, just I think a lot of people in the audience today can relate to this. Just 20 years ago, all of us, we probably only had 2 or 3 digital devices. So we probably had a handphone, a PC, and for the lucky few of us, we had a laptop. But fast forward 20 years today, look at us today. Some of us probably have 2 or 3 phones, and these are not just normal phones, these are smartphones that can semi-replace computers. And then in addition to laptops, we even have tablets that allows us to work on the go. And I think many of us here in the webinar are also wearing a digital watch that not only tells time, but also tracks our health, tracks our daily activity. And in addition to that, when we go home, there are so many smart devices now, like a smart TV, that you can use your voice to control the channel, to switch on, to switch off, and also link you directly to the internet. So what's quite clear to us is that as each generation passes and as time passes, I think technological penetration into our daily lives and into society will only increase. And it's not just increasing at a linear pace, but rather at an exponential pace. So a lot of reasons to be very bullish on technology over the next few decades. We move on to the next slide. This is another this is another reason to be bullish on technology, because certain sectors within technology, we're just simply at the start of a multi-decade opportunity. Take cloud as an example. In fact, it's an excellent example. Back in 2021, cloud spending was only $400 billion. It's already a really large figure, $400 billion. But in 2 years' time, it's expected that cloud spending will increase by 50% to $600 billion. So, I struggle to find which sectors or which industries can provide a 50% growth opportunity in the next 2 years. And at such large figures as well. We're not coming from a small denominator of a couple of hundred millions, but a couple of $100 billion. And we think that it is just at the start. This shift to the cloud is just at the beginning of a couple of decades, because it's a multi-decade opportunity, because companies are beginning to realize all the benefits of shifting to the cloud. Number one is that for a lot of small, medium enterprises, by shifting to the cloud, by outsourcing your data management as well as your infrastructure management to large company like AWS, Amazon, or Microsoft, what happens is that certain studies show that you can save up to 36% of the IT cost. And not only that, by outsourcing to these guys as well, you can outsource your IT team to them. You don't have to manage and hire your own IT team, and you don't have to run your own data centers. So it's really a lot of convenience. And then on top of that, as we have seen during COVID, there can be a lot of disruption, lockdowns. It affects your business continuity. Sometimes your servers are down and you can't get your IT guys there to get it up and running. But when you outsource this to big global companies like Microsoft as well as Amazon, they have round-the-clock IT teams that ensure this continuity. So we think all these benefits by shifting to the cloud is so obvious, and companies are just, starting to realize all these benefits. And Amazon and Microsoft simply have too much backlog to onboard all these companies. They've got so much demand, and so we think that this is a sector we really, really like and we're very positive on. And if we move on to the next slide, what I just showed you about the cloud, that is just one example. In Janus Henderson, we bucket them into 5 major teams. These are teams that we think would transform the technology industry over the next decade and provide investors with a lot of opportunities. So on the left-hand side, we've got fintech. So there are emerging number of companies out there today that provides financial services that's trying to provide financial services to the underdeveloped countries and the underserved population, such as the lower income. And then on the right-hand side of fintech, you've got Internet 3.0. So as we enter the third phase of the internet, things like the metaverse would almost certainly change the way we interact with each other, how we live, work, and play. And where we really like technology right now, at least in the short term, is on the right three columns over here: next generation infrastructure, AI and process automation, and electrification. So under next gen infrastructure, in that section over there that says low carbon infrastructure, it's really just what I was talking about. There's a lot of focus on carbon emissions and moving to the cloud, which was the previous example I was showing. Moving to the cloud really just reduces carbon emissions, because by outsourcing a poorly and inefficiently run data center, and when you outsource all this data management, infrastructure management to an efficiently run company like Microsoft or Amazon, you can save up to 80% of your electricity costs. So you use 5 times lesser electricity and therefore a lot lower carbon emission. And there's a lot of scrutiny right now on companies' carbon emissions. And so there's a lot of incentive for companies to continue moving to the cloud. Just another one more incentive to move to the cloud. And then under data security, we think that even when we enter a recession, if it comes, we think that spending on cybersecurity will continue to be very resilient, because as you all know, the number of cyber attacks have just been rising, and we think it will rise over the next 10 years. And chief technology officers in most of the Fortune 500 companies, when we interviewed them, they were quite clear on something. They're not going to spend lesser on cybersecurity, because nobody wants to be blamed at the end of the day for being a victim of a cyber attack. And the reason for that is because we slashed the cybersecurity spending budget by half. And then on the right-hand side, AI and process automation. As we move into a world whereby inflation seems to be slightly more persistent than what we're used to and higher than what we're used to, a lot of companies will begin to find ways to cut costs. And one of the costs is labor costs. Labor costs have been surging. And so there'll be a lot of investments by CEOs into software and into hardware that helps to reduce this labor costs. And so one of the companies we really like is called Impinj. This company produces RFID tags. So these RFID tags are being used to track their inventory. And one of the biggest users and customers of Impinj is actually UPS, United Parcel Services. So the CEO recently said that after using Impinj, it actually saved 20 million scans a day. So imagine how much labor cost he could actually save by using RFID. And not just labor costs being saved, he also mentioned that it is so much easier to track their inventory and their parcels. So a lot lesser parcels are actually being lost. So that's another way to save money as well. And on the right-hand side, you've got electrification. So we all know oil prices are rising. And then in Europe, we've got the Russian-Ukraine war going on. Gas prices are also rising. So this electrical cost has actually risen quite substantially over there, globally as well, not just in Europe. And so there's a lot of focus once more into building smart cities. More importantly, a lot of focus into purchasing equipment that can help to regulate electricity better by regulating your air conditioning and your lighting. So I think that we feel that companies that produces these devices as well as chips that manages this electricity and regulates the air conditioning, there's going to be a lot of demand for it over the next couple of years. So if we move on to the next slide. And for me, the third and perhaps the third last and perhaps most important reason why we like technology so much is that because at the end of the day, we are all investors. We're just trying to seek companies that can provide us share price appreciation. In order for companies to have consistent share price appreciation, they need to grow their earnings, because profitability is tied to share price, and fundamentals will begin to matter again. And we think that technology companies, compared to other companies in other sectors, they possess a lot of the attributes and do this very well in trying to grow their earnings year after year. And at Janus Henderson, we term this as the virtuous circle of investment and innovation. It's pretty much just a circle of success. And this circle is on the left-hand side over here. It all begins with superior earnings growth. Technology companies make a lot of money, and because of that, they're able to translate this into a very solid balance sheet and generate a lot of free cash flow. This allows them the flexibility and commitment to spend on R&D, research and development. By spending on research development, they're able to innovate and stay ahead of disruption. So not only can they disrupt other industries, but they can also stay ahead of the disruptors who are trying to disrupt them. And after that, by the next year, when they launch a new product or a successful service, they're able to retain that superior earnings growth, and this entire circle just repeats itself again. So, I'm going to go into more detail about why technology companies are so good at doing this and give you examples of that. So on the right-hand side, the first part of the wheel, which is superior earnings growth. In this chart over here, you can see that it plots the earnings of the MSCI IT index versus the MSCI non-IT index. So no IT companies in there. So the orange line is the IT index, the black line is the non-IT index. And over the last 10 years, you can see that the IT index far outperformed the non-IT index, 2.5 times earnings growth for the IT companies versus just 1.5 times for the non-IT companies. And then if we go on to the next slide, over here you can see on the left-hand side that all these superior earnings growth has really translated into a very solid balance sheet and a lot of free cash flow for IT companies. So down here, we've got 10 sectors. And as in that field over there that says net cash as percent of market cap, you want this figure to be as low as possible. For the IT companies, a negative 1%. What that really means is very simple. They have almost as much cash as debt. In fact, if we look at the biggest names, such as Apple, Microsoft, Google, these companies actually have even more cash than debt. The only reason they issue debt is for tax reasons. And so these are companies that generate so much free cash flow in a single year that they can not only cover their expenses for this year, but they can even cover their expenses for the next few years for some of them. And because of this, because of how solid their balance sheet is and how much free cash flow they can generate, if you look on the right-hand side, they can really spend a lot of money on research and development. And so these are the top 10 highest spending companies on R&D worldwide. And you can see that out of the 10 of them, 7 of them, all those that are highlighted in orange, 7 of them are all IT companies. And because of that, we are very confident that, over the next decade, we will see the technology companies really take market share away from the non-tech sector. And we're really seeing that happening. Amazon has really entered the grocery business through its acquisition of Whole Foods. And not only that, they're currently trying to build a pharmaceutical business by selling drugs online. And Apple as well. Apple has made it clear that it wants to go into the entertainment industry. So first, it went into music, and then now it's launched Apple TV. So we think that, as investors, one of the best sectors to invest into and to, stay ahead of disruption is actually to have exposure into the technology sector. The next slide, please. So, in the final part of this presentation, I shared with you, I really wish to share with you, what should investors actually look out for when you invest in a tech company? So a lot of it I've really shared just now in the last 2 slides, the kind of attributes that you should look out for in a good company. But really, I think at Janus Henderson, we've also invested in companies, tech companies for over the last 24 years, and we've seen a lot of bad companies as well. And the last 2 years, especially when we had zero interest rate policy as well as very high fiscal policy, when governments were giving out stimulus checks for free, certain parts of the tech market definitely became more bubbly and more overvalued than what we would like. And one example of this is the metaverse. It's this is a very when it was first when it first became mainstream sometime early last year, a lot of the companies that were associated with it, such as Unity and Roblox, within a month, their share price actually surged by 60 to 70%. In fact, some of the smaller caps almost doubled within a month. And so we really felt that, back then we really felt that we should stay away from it, even though we wanted to chase the trend and it was an exciting part of the stock market, but we really stayed away from it. And we were quite lucky because there were just too many open questions about the metaverse. Number one is that we do not know how it will develop into the future. Will it be a walled garden kind of concept whereby each company has its own version of its own metaverse? Or will it be a universal metaverse, one single platform whereby every company provides its products and services on the metaverse? We do not know the question to that and how it will develop. And neither do we have, when we look on the hardware side as well, we can't see a single dominant company that can provide the hardware to access the metaverse, which all consumers will use. But for us, I think the most important question when we wanted to invest into the metaverse was this: we simply cannot find a company that can provide a long-term competitive advantage in terms of product and service that allows it to monetize this consistently. And so we stayed away from the metaverse. We stayed away from a lot of these names like Roblox and Unity. And thankfully we did, because over the last 6 months, these companies, they dropped easily from 70 to 80% off their all-time highs. And these are companies that we continue to monitor, but we still do not want exposure to them because at this point we still feel that they are overvalued. And another example that I want to share with you is in the next slide. So as investors in the tech sector especially, it's always very exciting to try to be early. We want to invest into the disruptor very early because it can promise you phenomenal gains from doing that. But let me take you back 25 years ago to back in 1994 to 1995. And that was when we had the internet browser war moment. I'm not sure how many people here will remember that. But in 1994, a company called Netscape Navigator was launched, and it started to monopolize the entire internet browser market. Within 2 years, it was 82% of the browser market. And then in 1995, Microsoft started Internet Explorer, and Internet Explorer actually started quite slow. It was within a year, it managed to get 10.91%. But over the next 5 years, Internet Explorer was so successful that it completely displaced Netscape Navigator, which was the previous leader. And by 2000, Netscape Navigator actually ceased to exist. We don't see its name anymore. But fast forward again another 20 years, Internet Explorer is now just 5.11% of the market, almost negligible. And the dominant force over here is actually Google Chrome. So from this example, you can tell that investing early has a lot of can promise you a lot of potential returns, but at the same time, it comes with a lot of risks. And a lot of times when you're early, the actual leader has not even emerged yet. So this is just another example for investors to be cautious about when we want to chase the next most hyped industry or the most talked about disruptor. So exactly what kind of companies should we be investing? So in the next slide, you can see this. For me and for Janus Henderson, we think that the investing environment is going to normalize again. The years of zero interest rate policy and the years of governments giving out money for free, that's all over. We do not think that's going to come back anytime soon. So when we invest in companies, we need to make sure that these are companies that can generate enough free cash flow to fund their own expenses, instead of those unprofitable companies with no clear way of becoming profitable and constantly relying on external funding sources, such as going to the debt capital markets or going to VCs or PE firms. So companies like Apple, Facebook, Google, look at that. They've got a net cash balance sheet of $208 billion. So not only do they generate a lot of free cash flow every year, but they've got so much reserves. So in case we move into a recession, I think these are the kinds of companies that we want to be invested into. And there's so much has been talked about on the Chinese tech, about how difficult and a time that they're going through. But these guys, they're still so rich. They've got a net cash balance sheet of $90 billion. So they've got $90 billion more cash than debt. So you can be sure that even though we enter a recession, revenues might fall, Now, but these companies, they're very likely to come out of these recessions quite solid. And using this chart over here, I also want to debunk another myth. It's always been said that tech stocks are very volatile and they're too expensive. And so when we enter a recession, we don't want to be invested in them. And then these same people, they always talk about investing in those well-known companies, more defensive, such as Coca-Cola, McDonald's, P&G. The reason is very simple. They've been around for a long time, more than 50 years, 60 years. And they will be around, we are quite confident they will be around even after this recession, if it happens. But, I just want to point out that tech companies are not necessarily more expensive than the other defensive companies in other parts of the economy. Because over here, you can see that the average PE of Coca-Cola, McDonald's, and P&G is actually 23 times. Whereas if you compare that to Apple, Facebook, Google, it's 16 times. So tech companies are significantly cheaper in terms of price to earnings. And not only that, tech companies can actually provide investors more growth, almost 1.5 times more growth, 14% versus 8%. And when you move into a period of a recession, investors will start to reallocate their portfolios because they need to see companies that can grow during recession. And we think that tech companies are definitely going to be more able to grow during a recession than Coca-Cola, McDonald's, and P&G. And so in addition to the already very solid balance sheet of tech companies, they are also, on average, not too expensive and can provide a lot of growth for investors. And so if we move on to the next slide, this will be the last slide for this presentation. And, I spoke about a lot of things over the last half an hour, but, I just want to quickly recap some of the very important points. The first of which is we're still very positive on technology, and there are three main reasons for that. The first reason is because we really think that technological adoption is just going to increase. How technology will penetrate our lives is an irreversible trend that will only increase exponentially as each generation passes. And then the second reason we really like technology is because I shared with you those 5 themes that are at just the start of a multi-decade trend, providing investors with a lot of opportunities if you know how to select these companies. And then the third reason we really like tech companies is because, as I was showing you in that virtuous circle of success, tech companies possesses a lot of the attributes that make them great companies because they are able to grow earnings, have very solid balance sheet, and also have the commitment and flexibility to spend into R&D, thus allowing them to stay ahead of disruption and innovate to disrupt other markets. And then, at this point, I think a lot of us must be thinking, what kind of tech companies should I be investing into? And so if you look at the current environment today, interest rates are rising, inflation is coming up, we really think that fundamentals will begin to matter again. You really should avoid companies that are unprofitable, have no clear path to profitability, their products do not have clear competitive advantage over the long run, but rather you should invest in the companies that have defendable profits and market positions, a clear competitive advantage over their competitors. And then at the same time, we might or might not enter a recession. It's unclear, but it definitely doesn't hurt to invest in companies that have very strong balance sheets so they can tide through a recession. And these are companies that can also generate a lot of free cash flow. So when liquidity becomes a bit more tighter, when cost of borrowing increases, these companies do not need to rely on external markets because they have enough cash themselves. And then also look for companies that have a commitment to reinvest its profits into R&D, because that's very important. You might have very high earnings today, but if you don't reinvest into innovating yourself, into staying ahead of the disruption, a lot of the earnings can erode very quickly. And the economy is just littered with a lot of these examples, such as Kodak. Previously, it was one of the world's biggest camera maker, and now it ceases to exist because it just simply failed to innovate. And, I've reached the end of my presentation. I hope to have shared with you all the very convincing reasons to stay invested in technology. And I'll be happy to take any questions right now. Thank you.
Right. Thank you very much, Kenneth. So for our value clients, we are moving into this Q&A sessions. So if you have any questions, you feel free to post in the chat box. We'll try our very best to attend as much as based on the time permits, right? So Kenneth, obviously we prepare a few questions beforehand from our clients, from high net worth clients. They are quite concerned on the markets. So meanwhile, while we are waiting for more questions to come in, probably let's discuss on some of the questions that we received, right? So for the first one, do you see any similarities or differences of today inflations versus 1970s? So in your view, what's your investment strategy for investors today to invest in a high inflation environment?
Hey, Danny, I think that's a great question. On a macro from macro viewpoint, is there any similarities or differences? I think we can say for sure that there's a lot of that the main similarity between today's inflation and the 1970s is that a lot of it's being caused by a surge in oil prices. But I think that's where the similarities end, because back in 1970s, oil prices actually quadrupled in price. Today, if we think about it, I think we are maybe only oil prices have only increased by about I think some estimates shows only in real terms only increased by 60% as compared to when oil price was actually quite normal back in 2013, 2012. Because obviously, if you compare to what had happened the last 2 years, whereby we had a COVID lockdown and then there was really just a drop in economic activity, and so oil prices naturally dropped as well. Yes, compared to 2021, 2020, when we had $40 oil, $50 oil per barrel, we've doubled. But compared back to 2012, we haven't really increased that much in real terms. And so I think a lot of the inflation that we're seeing today is not just caused by oil prices. I'm sure oil prices are a big contributor to that, but it's also because we've had a COVID pandemic lockdown, and that really disrupted supply chains. So a lot of things that were supposed to work well, they stopped working so well. So you've had shipping prices increase by 3 or 4 times. And then at the same time, because of the lockdown, we have supply chain. More recently, we've had the Ukraine-Russian war. So that's also disrupted a lot of the things that a lot of the global movement that we're seeing that usually can happen. So gas prices have gone up tremendously because of the Ukraine-Russian war. And for us, we think that these issues at some point in time will abate, because as the world returns back to normalcy, as China hopefully comes out of its zero COVID policy, and as well as the fact that the Ukraine-Russian war at some point finds some kind of resolution, we think that inflation will begin to dial back. Oil prices should also recede a bit, and gas prices, obviously. So that's where the similarities and differences are between today's inflation and the 1970s. And in my view, what kind of investment strategy for investors today, right, in such a high inflation environment? I think we should look to invest into companies that are able to pass on this inflation cost to consumers. So companies with strong purchasing, strong bargaining power. So obviously, tech companies are one of them, because some of them, they've got so much bargaining power because the demand is so great. So Amazon AWS, as well as Microsoft Cloud, what I was talking about, they've got such a huge backlog for these kind of for companies to onboard onto the cloud. And so even though inflation is happening, but we see that if there's any rises in cost, which there isn't much as well, but if there's any rises in cost, they're able to pass on to these consumers.
Right, thank you very much. And right, like how we see the crude oil prices is starting on a downtrend, right? So probably inflations could cool down a little bit. So second question is, do you foresee recessions coming? Based on historical basis, what is the effect of recessions towards mega cap tech sector? And has the tech sector bottomed out at this current juncture?
So that's a great question. I think that's the million-dollar question. Everybody wants to know whether a recession is coming. We definitely see that we have an economic advisor, and he definitely sees that one of the leading indicators of recession is the amount of money supply in the global economy, and money supply in the developed markets, at least for the US as well as Europe, um, has been shrinking. And these money supply and shrinking money supply is typically a leading indicator of lower economic activity, because PMIs will fall, and then growth and economic activity will fall. And so falling economic activity does point to a recession. But we're not macroeconomic experts, and as technology investors, we do not try to forecast a recession coming in. Um, but to your second question, based on historical basis, what is the effect of recession towards the mega cap sector? So it's difficult to look at history, because no time in history, since we were investing during the dot-com bubble till today, have we seen the dominance of such a few companies. So companies like Apple, Google, Amazon, to a certain extent, Facebook as well. These companies have pretty much no competitors. We have never seen such dominance before on a global scale, even back during the dot-com bubble. So it is difficult to compare these mega caps towards more expensive names during the dot-com bubble, because those companies just had a lot of market capitalization due to the over exuberance and how bubbly the market was at that point in time. But for us, we've had a lot of experience in investing, and we really feel that on the valuation side, um, these mega caps have really receded quite a bit, 10 to 20% off their all-time highs, and it's really discounted any fall in earnings that they would have over the next 6 months at least. So it's come down, not because earnings are weak today, but it's come down because investors are already expecting their earnings to be weak in the future. So to a certain extent, we feel that there's a lot of valuation support right now for these mega cap companies. And have are we seeing the bottom? We're not very sure that this is the bottom, but we believe that a lot of the interest rate hikes, a lot of the pessimism in terms of their earnings coming down, it has already been, priced in, and we just think that we're at a lot more comfortable buying into tech companies today as compared to 2021 or 2020.
Thank you. So, for the third questions, probably what's your view on how much interest rate hike and recession has been priced in?
I think that's a great question. You know, we definitely feel that a lot of the inflation has already happened, because inflation. I think this idea of inflation is market narratives change very fast. Just last year in July, if you were talking to me, the main narrative would be inflation is transitory. But now fast forward 1 year, everyone seems to be saying inflation is permanent. But we take the middle ground. We think that inflation is already at its peak, and or rather, it doesn't have much room to run from here, because number one, um, back in 2021, prices were actually quite low. We're just coming up from the COVID pandemic, so unemployment was high. Services sector, a lot of people were unemployed over there, and then there wasn't a lot of demand for goods at that point in time. But so the base was quite low in terms of prices, and that's why it's easy to see a high inflation figure in 2022 when you compare to 2021. But now thinking about 2023, base effects are a lot higher right now when prices are so much higher, 9.1, 8.5% higher. How much higher can it be from here, right? So we definitely think that we might already be past the peak inflation. We saw CPI drop last month, but these are just noise, and we might actually go up again. But in any case, we think that we are close to it at peak inflation, or And so a lot of the prices that we see in the stock market, a lot of the sell-off that we saw at the start of the year, it's come down a lot because investors were actually really fearful that we saw that the inflation would persist for a long time. And as a result of that, interest rates will increase a lot. And obviously, we saw that nice rebound in the chart I showed just now over the last 2 months. I think investors are beginning to realize that they priced in too much inflation and too much hike in interest rates. And so I think that too much has been priced in actually, and we are pretty much like the fears of it, a higher interest rate and recession has actually been priced in to a great extent.
Right. Thank you. For the fourth questions, how do you see semicon cycle play out for this round?
Another great question, and another topic that keeps coming out during our client conversations here. Let me think about how I can best explain this. I think that semiconductors, there's been a lot of hype about it since last year because there's been so much news about the supply chain issues, about how long you have to wait for your chips to arrive, and companies are not able to produce their end devices. Like car companies are stuck because they can't get their chips, or there's even been fears that Apple cannot produce the iPhones because chips are coming in too slowly from TSMC.
Yeah.
And so there was that huge surge in semiconductor prices over the last, at least towards the end of 2021, when we were seeing things like, a 21-week lead time or like 40 weeks lead time, whereby companies, have to place their orders 40 weeks in advance, and then only 40 weeks after they get their chips. And because of that surge, we really felt at a point in time that we had semiconductor exposure, but we we begin to sell, we begin to trim our position because we felt that there's a lot of overvaluation. And so today, if you ask us, we are not especially bullish on semiconductors, even though there's a lot of demand, because we think that TSMC and a lot of the big names like Intel, they have really the factories are already in order, all the equipment they require are already there. And so they'll be able to resolve this backlog and increase supply tremendously very quickly. And we should see this happening in the next few months. And by the start of next year, we think that a lot of the demand will be fulfilled already. Maybe some chips that are more complicated to make, that will take a bit of time, but a big part of the demand will be fulfilled. And that's when you see that's why over the last couple of months, we've got a sell-off in the semiconductor space, because investors are beginning to realize that. And the smaller semiconductors, these will be the most impacted. But we're very selective. We continue to still have exposure to certain semiconductors. So even though we're not very bullish on the sector, but there are certain companies in there like TSMC. Our PM has covered TSMC for over 14 years, and this is a company that has only had 1 year whereby profitability dropped. That was back in the GFC. And so he still continues to like the company a lot, because even when we enter a recession next year, if we enter into one, he doesn't expect the company to have a drop in profitability. Will it rise 10%, 20%? Probably not. But he thinks that the company can still eke out a surprise growth in revenues that's not being priced into the market right now. And then another company we like is Infineon. This is a European semiconductor company that will be very familiar to a lot of investors who invest into semiconductors. This is a company we like because number one, it's quite cheap today, 13, 14 times PE. And then this also the chips that they produce, they are the dominant player in renewable energy devices. So your wind power, solar power, they all need chips. And Infineon is basically responsible for more than 50% of these chips in the market.
Right. Thank you very much, Kenneth. The last questions. If given you a few seconds, buy, hold, and sell call, which one will you choose now?
I will I would think the time in the market for an investor is very important. We shouldn't try to time the market because we've all seen the chart whereby you know, just missing out the 10 best days of the S&P 500, you can lose up to 20 to 30% of the returns over the next 10 years. So I would definitely, if I have spare cash, I would be buying into the dip that the tech market is seeing right now.
Thank you very much, Kenneth, for your time and for informative sharing. So I think we are close to 6:30 now. So let me do a quick recap on what mentioned by Kenneth. So I think for most of these profit technology companies, that what we think from Affin Bank view is that it's going to be resilient in recession time. As these companies has no pressure in terms of cost cutting, and they are going to continue to disrupt the industry. And we have seen this in this global financial crisis, whereby it happened in 2007 and 8. Many of these leading mega cap tech companies, they basically found their feet during recessions and out of recession as well. So these tech companies disrupt the companies that badly hit by recessions and continue to grow drastically, like Amazon, like Facebook, like Google. So these mega cap companies, what we think also they have the highest R&D spending. They spend almost 10 over billions dollars to increase other sector productivity and efficiencies, like healthcare, like financials, like industrials. So we just want to wish good luck to others guys out there in the sectors there trying to throw tons of money to try to hit these mega cap technologies companies by innovating new products. So it's basically the probability is small for them to beat them out, right? So basically, like how Jeff Bezos always mentions, your margin is my opportunities. So last but not least, these mega cap tech companies also are profitable in that sense that they are do need to do any financial engineering, for example, borrow monies, trying to do share buyback, whereby every sectors out there is trying to do so by borrowing cheap money in the markets to fill up their EPS, right? So when the interest rates start to in a hiking environment, this sector is they feel the burns. So compared to what happened in technology companies, they are profitable in generating few $100 million of free cash flow on their books, like how mentioned by Kenneth. So basically, this is what for now those US and Chinese tech companies they are doing in terms of doing share buyback to basically boost up their clients' confidence. So to summarize, here's some of the wealth solutions that we provide in Affin Bank. We believe every investor has their own risk appetite. Hence, get in touch with your respective dedicated relationship managers to find out more. Now, if you are interested to know more investment opportunity in Affin Bank, right? We have more than 100 funds for your stack in our fund shelf. So we do offer advisory service as well, which is to customize a private investment portfolio that best suits your ideal risk and returns preference. So we always think smart investors to manage their wealth preservation, we always consider opportunities for the long term. And as the uncertainties basically comes with opportunities. So the key thing right now, what we think is we need to ensure the right level of diversifications portfolio. In Affin Bank, we stress on the needs for diversification strategy to ensure that we do not put all eggs in one basket. So it's very difficult for us to predict the best performance for each year. So what we need to do is diversify into an optimized portfolio to achieve optimized returns in each year. So next, we also prepare some of the investment portfolio that we are targeting returns about 5.5 to 6% per annum based on 3 years annualized returns back testing that we did. So this portfolio is basically a combination of bond and equities. This portfolio is categorized as into a moderate conservative risk level with 67% into fixed income and sukuk that give an average yield at about 4 to 4.5% to investors. Then 32% of the investment of your funds will be putting into equities to capture the upside risk, to capture the upside growth as well, by invest into some of the mega cap technology companies where Kenneth shared today, right? So as we see the market currently now is in a sweet spot, that the global market valuation currently is at reasonable level for us to go in, plus a structural growth that we see with the mega cap technology business model, and also their resilient corporate earnings. So to determine whether a good portfolio returns, we also should assess the periods whereby uncertainties happen, like the past 1 year. So this model portfolio experienced a drawdown with only 4% compared to the broad market index, whereby I showed in the first slide just now. If we see the global index is for almost 20% in this year. So hence, we think this portfolio should help customers in terms of risk management objective through a diversification strategy. At the same time, customers are able to target the returns about 6% per annum over the next 3 years. So last but not least, we do value our respective clients. Hence, we have some campaigns for customers that participate in this webinar. We have this very attractive campaign promotion for you starting from July onwards. You may enjoy as high as 16.38% per annum by placing your money into FD with us for 1 month, together with investment, either in ASMB funds or unit trust fund, or the funds mentioned by Kenneth and I just now, which is TA Global Technology Funds. So do feel free to find out more with your respective RMs. And last but not least, we also have this birthday campaign, which we are giving only 1% sales charge on selective unit trust investment during your birthday month. All right, but terms and conditions apply. Thank you very much for all the investors, clients, and Affin Bank staff that stay with us in these webinar sessions. We really appreciate for your time, and special thanks to Kenneth for your time. Stay safe and have a nice day. Bye-bye.
Thank you very much, Danny. Thank you very much.
Thanks, Kenneth.